Hey there, Canadian wealth secret seekers. It's Kyle here with another secret sauce episode. We are not going to waste any time and we're going to dig right in to a case study here today to overview a particular listener who reached out for a discovery call and provided some context ahead of the call. So I have still not yet met this individual. We're going to keep things anonymous here, but I'm going to share the context because we can all learn something from each individual scenario out there. Some of these ideas or some of these challenges or situations may apply to you in some way, shape, or form. Of course, every person's scenario is different, so don't take any of this as advice, investment advice, tax advice, legal advice, none of those things, but use this as a perspective for your own situation, and it might have you thinking maybe a little bit differently about some of the things that you either are doing or were thinking about doing moving forward. So I'm not going to waste any time here. I'm going to bring this up on the screen, and I blanked out all the information, so completely anonymous here. But this is a client who has reached out, or I should say a listener, not a client, a listener who's reached out for a discovery call and has provided some context. So this is a little bit about this person. They're a mortgage broker. They're licensed in multiple provinces, and they've been doing this for 3 years, and they've had some success here. Shows that they've funded $22 million in mortgages so far, and this individual is starting their own team. That is awesome to hear. Way at the end of this particular email, I'm going to come back to it, but it talks about this idea of not having or not wanting to worry about income and being able to take time off and enjoy life. Number one, first and foremost, if you are a business owner, is trying to find a way that you can build out a team so that you aren't necessarily always having to work in the business. So what we're talking about here is, and we'll use mortgage, the mortgage broker industry as an example. If you are the mortgage agent or the mortgage broker and you stop working, then you stop earning income. Whereas if you build out a team, right, the same works for real estate agents, the same works out for people in the financial space. It works for a lot of different businesses. If you're able to build a business that can run without you actually physically needing to be there, then you are in good shape. Real estate can also be one of these businesses, right? If you build out a great property management team or you work with a great property manager, even though you're still going to be needed for some decisions, you're not going to necessarily have to be there for the day-to-day. I don't have to actually go to see properties, and I don't have to assess whether something needs to be repaired or not because we have a who to do that work. I don't need to worry about the how. We'll do a little book drop right there, Who Not How by Dan Sullivan. It is on our great investment book list on our website at canadianwealthsecrets.com/books. Go check out that book list. But Who Not How is a great business book. I have it in our investment book list because a business is one of the greatest investments that you can ever make, right? This thing is going to not be, up and down with the market, and it's not worried, you're not worried about stock price, you're worried about cash flow. So businesses are great. So I would say first and foremost for this individual, continuing to build out that team and focusing a lot of time and effort on that is going to be really important. This person has been incorporated since September 2023 and, went to the accountant to try to figure out some tax minimization advice. And they're saying that they weren't very helpful. They didn't get any answers out of them when they asked tax minimization questions. The reality is, again, we've said it before, accountants really aren't there to provide you with tax advice suggesting you should go buy this or you should go do that, but rather they're there to account for what you have done. Of course, they're going to give you some general advice, but they don't actually want to be put on the hook for giving you any of that advice for you to take action in one way or the other. So this particular individual is taking a $2,000 per month salary. She has a spouse, and the spouse is earning a different income. I'm not exactly sure what the spouse is earning, but it sounds like they don't require a ton of cash to come out of her business, which is great. So she does $2,000 a month as a salary, and dividends from the corp each year are at about $20,000. I might argue that if that's a routine, I might consider maybe looking at increasing the salary versus, say, taking out that big dividend at the end, because again, there's a lot of room there in those salary tax brackets for you to be able to take more salary without it hurting you too much on the tax side. So it's taking out a good amount, and there's about 50,000 in the corporation not doing anything. All right, and then they talk about the mortgage. So they have a home, they own this home personally, so it is not corporately, right? So they'll be able to take advantage of the primary home, that basically the capital gains exemption on your primary residence, which is great. Home's worth about 700,000, and there is a mortgage on it at about 340,000, it sounds like. That balance, so first off, I like it because it's under 50% loan to value. So they're not over leveraged, right? They haven't leveraged up to 80% or 90% or something like that. And listen to this, their interest rate is 1.74%, which is awesome, but it does expire November 2025. So just over a year from now, that will expire. Now, one of the benefits, as you probably know, Bank of Canada has been decreasing rates, and it sounds like another rate cut's coming as I record this, beginning of September. Another rate cut is coming. It looks like, we can't guarantee it, but it sounds like rate cuts are going to continue. The bank, or the Fed in the United States, is set to make their first cut this month as well, which is what it sounds like. And that typically means that rate cuts will continue for the foreseeable future, because rate cuts typically happen after they should have happened, because there's a lot of trailing data that the Fed and the Bank of Canada are using, and therefore they're usually late to the party, meaning the economy is already puttering, it's already struggling, and the reality is that historically it means recession time. A lot of us probably recognize that we're actually in a recession already. However, we will see. You never know in the future, but that's what things look like. So right now, the interest rate's great. Will it go up by next year? Like they're going to have to pay more than 1.74%, I would guess. But it's not going to be anywhere near those numbers that we're seeing now. At least that's not what anyone would anticipate. All right, so that's a good thing. They're not over leveraged by any means. They have access to a home equity line of credit, which is great. I like to keep a chunk of a home equity line of credit available as an emergency fund. If things ever got tight, you can definitely do that. And therefore, I would argue keeping that mortgage as is probably a good move for this family currently, and just continuing to pay as is. All right. Now they talk about some personal primary or permanent life insurance policy, and the kids even have different permanent policies. So that's fantastic. Great to hear it. And the question at the bottom is, what they're interested in now is tax minimization and paying off the mortgage. So the question here, it's kind of like two things. It's like tax minimization, nobody wants to pay tax, and paying off the mortgage, nobody wants to pay interest. So I want to really take that head on here. Based on this situation, we go back and we think about, okay, it sounds like they don't need a ton of time, or not time, but money at a personal level, but they would need more money at a personal level if they wanted to, say, pay off the mortgage. Well, the problem here is that we've got conflicting issues. We have tax minimization, and then we also have paying off a mortgage. Now, because this individual is only taking about $2,000 per month, and that extra $20K would put it up to, let's call it around $3,000 a month, that means that there's some room there if they did want to increase the amount of that salary coming out currently, and they could take that and put it towards, say, the mortgage, help to pay that down. Now they're paying less interest there. They are going to pay more tax because they have to pay the personal tax on the money they pull from the corporation. However, they're going to pay less interest. The problem is that the tax they're going to pay is significantly more than the 1.74%. Now, even if that 1.74% goes up to, say, 3.5% or 4% come November 25, I believe that it's going to actually be a little bit of a conflict here, that you want tax minimization, but you also want to pay off the mortgage. Because why? Because people don't want to pay interest. Right now, the actual CPI data, according to the government, is sitting somewhere around 3%, meaning that the money you're holding in your pocket is actually losing its value faster than the interest that you're paying. Meaning that if I can actually hold on to this mortgage as long as possible, right? If inflation is higher than the actual interest I owe on this property, you're actually making money. Now it's all abstract, right? This is the hard part. It's abstract, but you're actually making money here because you are paying such a low amount of interest to borrow that money while money is losing its value. All right. Money is losing its value, meaning that if you wanted to pay this off in a year from now, you would require actually less money, or you would require, your money would be worth less, meaning you need more of it to buy goods and services, but you need the same amount to pay off this debt. So we've talked about this in our good debt, bad debt episode, where we talked about why the wealthy do not pay down debt and why they actually typically borrow instead of sell assets to actually live their lifestyle and fund their lifestyle. Well, this is a similar effect that's going on here. So I would advocate not to take additional funds out of the corporation, pay more tax now in order to pay off very, very cheap dollars here. I might look to maybe, they had mentioned that there's some student debt. You might take some more of this money in order to pay off some of that student debt balance, right? There's $70,000 in student loan. If that student loan has a high rate of interest, if it's 6%, 7%, 8%, maybe it might make sense to take that little extra bit of money and actually put it there, but I wouldn't be putting it on my mortgage. Now, if the government's allowing you to go with 0% interest for any period of time, I actually wouldn't touch that either. I'd be thinking about what sort of assets can I purchase in the meantime while I have this very cheap or very free money, depending on what the interest rate is on that student loan debt. So what are some of the things that can be done if we're not going to take the $50,000, say, out of the corporation? That $50,000, if we took it all out today in order to pay off all of the student debt, you're going to lose a good chunk of it, right? You're taking an extra $50,000 to add on to your your current salary. Would that maybe make sense if your interest debt on that student loan is 8%? Absolutely, it would make sense because you're gonna have to pay that off at some point anyway, unless you could find an investment that's going to earn you more than the 8%. That's a little bit of a risky proposition, even though the stock market on average could get you between 8 and 10%. Feels a little riskier, and I think most people wouldn't work, to do that. Now, if I could find a real estate property that cash flows so that cash flow would actually put more money in my pocket that I could then redirect to this debt, then I'd be all for that as well. In the meantime, though, if the choice is to keep the $50,000 inside the corporation, what we want to start thinking about is how can we take that money and slowly start removing the tax target off the back of those retained earnings inside the corporation before utilizing those dollars for investment or for cash flow. Okay. Now, in this particular case, if these are low interest loans, and it doesn't make sense to take the $50,000 out in order to pay down that debt, we would potentially look at permanent life insurance inside of the corporation. So that is corporate-owned life insurance, and it's going to be structured to have a high early cash value so that it can be leveraged for emergencies or liquidity inside the company, right? Maybe there's a cash flow crunch for whatever reason, or for asset purchases inside of the corporation. The one thing I can say, though, is that if you need that $50,000 in your personal pocket, like today or in the next 3 to 6 months, and you need it all because that interest rate is too high on the student loan, then I would argue that maybe a permanent policy doesn't make sense yet inside the corporation for those retained earnings. Or maybe you might consider having a small permanent policy started if you're only taking a portion of those retained earnings out now. So I'm really interested to hear a little bit more from this individual about the interest that they are paying on that student loan and whether it does make sense for that person to start taking out some of that money in order to start knocking that debt down. The other thing to consider is there extra money in the household outside of this business that's generating this money, this extra cash flow? Is there extra money that's already being taxed from a T4 job? This is something we also don't know in this case study yet. But if the spouse is earning a certain amount of money and there is money already sitting there that's been taxed, it may make more sense for that money to go towards the student debt rather than taking more money out of the corporation, having that get forced to be taxed at a personal level, and then paying off that debt. So, in this secret sauce episode, as you can tell, this is a very specific scenario, but we still don't have the right answer for this particular family because there's still some questions, some unknowns that we don't have. We don't have an interest rate for that student loan. We also don't know what the T4 income is of the spouse. And we don't know how much money is sort of quote unquote sitting around at a personal level. If we want to utilize personal already tax, so after tax dollars, in order to address any of these personal debts where the interest rate is high enough to make sense to start paying it down more aggressively, rather than trying to pull more money out of the corporation and paying more personal tax than maybe we need to. So that's the secret sauce for today, is what kind of debt do you have? And if it does make sense to keep that debt, meaning low interest rates, right? And using inflation as a good number in a comparison to try to figure out, does that make sense? Also deciding, does it make more sense for me to invest my dollars, earn a higher rate of interest, and then utilizing the cash flow from that particular investment in order to pay down that debt instead? And now you get sort of a win-win. On the other hand, if that interest rate's really high, it might make sense to take the Dave Ramsey approach and start knocking that thing down as aggressively as possible. But remember, if you have a company and if you also have some T4 type income in the household, if we can rely on the T4 income that's already been taxed, it's been forced through the tax door, we're going to try to rely on that first. We're going to try to take that retained earnings and we're going to try to keep as much inside the corporation and slowly remove that tax target off the back in order to keep tax to a very minimal level if we can help it. So hopefully you found this helpful, even if it's just a piece of this particular episode. If you found this helpful, please share the podcast in the same way that you found it. And also do us a huge solid and leave us a rating and review on Apple Podcasts, Spotify, YouTube, or wherever you're getting this podcast currently. And finally, if you'd like to reach out, have your scenario reviewed on a discovery call, you can do so over at canadianwealthsecrets.com/discovery. And we will hop on and have a quick chat to decide what is your next step in your personal or corporate wealth journey. All right, my friends, take care and have an awesome rest of your day.